Welcome to another episode or edition of Markonomics 101, the podcast. Be informed, not misled. This is the place to get information, education without fabrication. This also is dedicated to the NBA playoffs. And of course, I am a great player. Still at my tender age, I can still hit it like anybody. Watch. Nothing but net. Woo! All right. Okay, so let's go on to the charts and start talking about them. Well, God, I hope she's not too pissed, but anyway. Let's go on to the to look at the charts, okay? So first we have the sort of the big pictures where we're going to start, okay? Now, this is the Standard & Poor's 500 over the last 20 years. Now, the reason this one's important to look at is because you have to start looking from the top down. Sometimes you look at short intervals like 2 hours, even a half hour. Other times, useful to look for the last like 20 to 50 years. In this case, it's essential to look at a long-term chart to really know what's going on, okay? To really understand it. So here we go. This one has been in what we call a reverse wave. So I'm just going to write this here. I'm writing it in red simply because it's a bearish chart, and it's called a reverse wave, okay? What happens in a reverse wave is you do this. Basically, it's like a megaphone. So this would be point number 1. This would be point number 2 down here, and so on and so forth. And that's why we were able to predict when the market was here and the world was coming to an end, and basically no one was going to survive. Oh, and we were all going to die from the flu. Well, I predicted actually that the market was going to make new highs. Look at that right there. That's 0.7. That's why we're about done. Okay, because we're about done. Let's go on to the next one. Oh, here we go. Okay, next chart. This is the NASDAQ over 20 years. And the reason I put this chart in is because this shows the bubble to beat all bubbles. Okay, this is the everything bubble. Everything is bubbling up, except 7-Up, of course. All right, so here we go. And we draw it in green. Okay, now here's what we have. We have what's called an accelerated trend line. That's where we continue to go higher at an accelerating rate, looking like a parabola. The reason that is important is because it means that there are fewer sellers all the time. Why is that important? Because eventually people are paying anything to buy a company that's worth a lot less than they're paying. They're only paying for it because it's the hip thing to do. You know, if you want to be really hip, go the other direction. You should be buying low and selling high. I mean, you cannot possibly buy anything like this and buy low. You can hope it goes higher, but hope makes a terrible ally, I can assure you. So we're going to go on to the next one. Here we go. There we go. All right. Next chart is, this is a Dow Jones Industrial for the last year. The reason I put this on, it's really not that important of an index anymore. Really, it's sort of the name index, but when it comes right down to it, it's constructed terribly, and it's overweighted with banks. Today's economy, it's probably way overweighted in banks. So the Dow Jones did not make a new high. You notice the NASDAQ did, the Standard & Poor's 500 did, but this has not. And this is very important. Notice that we've got right here a high right there and another high right there. This high being lower. Okay, so we have a little rally here. Okay, now there's a rally. There's a rally going right here. I should put that in green. There we go. Okay. Still learning this equipment. Anyway, so that's the rally in green. It's a short-term rally, but I would expect that it will not make a new high. And the reason I say that is because of the banking sector. The banking sector is the only reason the Dow is even going up now, because it's basically, this is the time of a rally when even a turd floats to the surface, okay? And these are turds floating to the surface. So don't take the Dow as indicative of the market because of the way it's measured. For example, it's measured by price, okay? Other indexes are measured by market capitalization. This is price weighted. In other words, when Apple did a 10-for-1 split, it became 10% as important to determining the Dow. That doesn't tell you anything, does it? Except that it's a bad index, by the way. Okay. This is the Standard & Poor's 500 for last year. We looked at it for 20 years, just recently at the very beginning. And what I want to do is show you the Standard & Poor's 500, which is really, if you think about it, it's a combination of the NASDAQ, which is all technology, and the Dow, which is heavily weighted in industrial and financial companies. The Dow has some technology, believe me, they're gaining that, but the way that they measure the index is so preposterous that it's practically valueless in terms of understanding the markets. So the Standard & Poor's is a little bit better, but it's still cap weighted is another problem. The reason that's a problem is because you have 5 or 6 or 7 companies that represent roughly 30% of the entire market. Okay, when you have 30, a handful of companies representing the market, you got problems. So this one is Standard & Poor's, as I said, 500. You've already seen it. This is 0.7 right here from the last graph. I didn't draw it very well, but it's right here, exact point. This was 6 on the reverse wave. This was 5 right here. Okay, so this is basically that first chart I showed you, except blown up so you were closer. It's like zooming in on it. I basically zoomed in on the chart. Now, Standard & Poor's 500, the way to think of it is this. It's been in an uptrend, pretty good one for a little while. It broke the uptrend. The pattern is now broken. Okay, that is pretty important. That's pretty important because while it may still rally, the pattern's broken. I mean, there's no reason to buy it here, as far as I can tell. Buy low, sell high, and you want to buy here? Why? I mean, why? All right, now we're going to look at another part here, which should be looked at. Notice we have a little bit of a rally here, right here. And this rally has exceeded this point. So now we have a high above a high. But we don't have a low above a low yet. This thing might could easily do this. And I don't know which way it's going to go. To be honest, it's coin toss. When something becomes a coin toss, don't bother. Don't bother. Okay, just let it play itself out. Okay, that's always the right. It is never wrong to go to cash, except when you do it permanently and it becomes worth less and less and less each day because our Fed loves to print money and just float it all around. Money, money, money. Okay, so we're going to go on to the next one, and that is the NASDAQ for 1 year. Okay, the NASDAQ for 1 year. What do you think? Okay, so we've got a pretty good looking chart, actually. We've got this, but it's also a broken pattern. Broke it right here, right there. So now what? This is no man's land right here. I'm going to write that so you all understand that. I got seasoned penmanship, by the way. Oh God. Oh my God. Sorry about that. No man's land. But anyway, once a pattern's broken, there's no point to be in it. I mean, it's a coin toss at that point. You want situations only that are setups, good risk return ratios. Doesn't mean you're going to make money. Sometimes people are wrong. Even I have been wrong before. I've been wrong once in a while. Thank God I lived through last week because I kind of blew it last week. But anyway, here we go. Let's see. Okay. Now, why am I putting this chart up? The Dow Jones Transportation Index, used to be known as the rails, now known as the trannies, but I like to be very politically correct, so we will refer to them as transgender Americans, okay? So no one can possibly be offended because I don't want to offend anybody. Okay, so why is this important? Because it made a new oops, did something wrong there. There we go. Sorry. It did something that the Dow did not do, and that is it made a new high right here. And look at that. See, that's where it was before. That's where it is now. Looks pretty good, actually. The trend actually looks pretty good. I would say not bad. I think this one is one of the healthier charts I've seen. It still actually hasn't broken the trend line yet. But a Dow Jones sell signal occurs when the transgender Americans do not confirm the Dow Jones Industrials, and they don't right now. Now, the Dow could make new highs, and then it would be a Dow Jones theory or Dow theory buy signal, but we don't have that yet. And this is a cause of concern because I don't know about you, but if airlines are going to lose $128 billion next quarter and they're requiring some kind of bailout, they're not doing very well, are they? And, you know, I don't see, you know, maybe there's some deliveries around, but, you know, Amazon is not a transportation company. So anyway, so we're going to go on to the next. That's it. Okay, so what we're going to do now is look at 6 stocks that represent about 25% of the entire market cap. So, you know, I can look at indexes all day long, but these companies matter, you know. No offense to other companies, by the way, just that, you know, these companies, high cap companies matter, okay? So here we go. This is Apple Corporation, and, you know, or as the Germans call it, Apfel Corporation. Okay, you know what they say in Germany. You know, I say Apfel. All right, so here we go. Now, Apple's a little bit of a problem. You know, it's a little bit of a problem. See, the thing about Apple is it's kind of, well, first of all, let me draw the trend line, and you can see it's kind of Okay, first, here we go. It looks kind of like this. And, you know, I kind of drew it sloppily, but the point was right here, somewhere around there, the pattern broke. And not only that, but, you know, we also had a topping pattern, you know, like that to form. It's really called a rounded top, but it's usually sort of a head and shoulders. Head and shoulders occurs when you have a high, you know, like a high here, you know, a higher high here, and then a lower high again, which we have right now. So it looks like it, okay? But I'm going to tell you that it is it, because it's a matter of odds. It's always a matter of assessing the odds. No trade is ever guaranteed to work. No trade is ever guaranteed anything, okay? Some incredible things have happened before, and, you know, you have to expect the unexpected, which I don't know how the hell you do that. Anyway, this one is Amazon. This one is worth a lot of money. Oh, Ace he hates Amazon. God, he hates the delivery people and everything. So just ignore him. All right. So then we're going to look at Amazon, and Amazon's a mixed bag. Mixed the wrong way, unfortunately. Here's the uptrend. Real nice one right here. Look at that. I mean, that's beautiful. Oh, I love it. All right. Now what we're going to do is we're going to look at what happened after. Now, Amazon is also rallying, but it is no guarantee unless it makes a new high. It's bad news. A high below a high, that's a recipe for disaster. And right now, Amazon is in a head and shoulders pattern. Look at that. And here's the right here. Here's the Maginot line right there. Okay, if it breaks down through that right there, it's going to be Katie bar the door. I never understood what Katie bar the door meant, but I know to say it when you mean something's going to go out of control. So we're going to basically, you got to watch this level, which is, you know, roughly 2,900 on Amazon. And if it breaks 2,900, we're in trouble. And it will, unfortunately, break 2,900. Okay, so we're gonna do Facebook next. The people who are so famous for free speech and great customer service. I mean, you can call Facebook 24/7. You know, somebody's gonna pick up the phone. I know Ace. I know Ace. I know Ace. It's not fair. Okay, he thinks it's not fair. But the fact of the matter is, they give you such great customer service that you know, they can afford it. After all, you know, it's Facebook. So. But let's look at it as a company. Okay, let's look at it as an investment. As an investment, it has the same, it starts looking the same as everything else. You got an uptrend, looks good. You got a break right here, not so good, not so good at all. And then you have then you have this. Then you have a shoulder right here. So this is a shoulder, a head, oops, and a shoulder. And so you have both a rounded top, the head and shoulders, and look at this. Kind of looks familiar, doesn't it? Looks like Amazon. Now, if you have a break here below 250, I would say watch out. And I'm going to put here a stop sign so that you, well, I mean, it kind of screwed that one up, but I put a stop sign here just so that you stop. Okay, so on to the next chart. Okay, and here we go with another one. Google. Not that Google looks anything different, but we're going to show you anyway, whether you like it or not. So Google, another one, straight up, good chart for a while. Now, not such a good chart. See, same pattern right here. Same pattern. Okay. I don't know what's with Ace today. I'm sorry, but he doesn't agree with any of my picks. But I'd watch out for this one. And notice the fact that all of them look this way, and they represent 30% of the market. 30%. How can the market go up when 30% of them are in bad patterns? Okay. All right. So we will move on. The last one is Microsoft, and this one is also deserving of a green pen, green line, and deserving of a, it's once again, head and shoulders top, right here, just like that. And this is where you draw chartists refer to that as a neckline. That's a support line. It's a head and shoulders, you have a neck. So, that's why they call it the neckline. If it goes below here, I'd watch out. As a matter of fact, I have Bartholomew here to help me make decisions. And look what he's saying. Stop in the name of love before you break my heart. Gotta stop that. Okay. I just felt very musical. All right. Let's see. So we are going to go on to the next chart. Now, Tesla, everybody's favorite stock. You know what? This Tesla, I have to admit, I got to admit this. Everybody that I know that owns one thinks it's the best thing since something. Sliced bread, maybe? I don't know. But Tesla, look at this. Look at this pattern. It's a great one. And then you've got, unfortunately, though, you've got this. And this is actually a bullish pattern, believe it or not. Tesla is the only reason that I wouldn't go short now the market, because this is actually normally a bullish pattern. But if you own it, I'd get the hell out of it. I would not own this thing for the world. It's just not worth it. As a matter of fact, I'd rather own this. This has the same chance of going up as Tesla. All right. So we will now move on. All right. This is UGL, leveraged ETF for gold. I've been bullish on gold for a long time, and I became bearish on gold temporarily for a little bit of time. I started to think that I exercised my stop limits. Well, gold, believe it or not, looks kind of bullish to me again. One of the things you never do, and I would never do this, is go short an asset in a long-term bull market. You don't try to play the counter trends. You'll lose money. I guarantee it. So even though it went this way, here, I wouldn't go short it. I wouldn't go short it simply because it's in a long-run bull market. This thing is going to go a long way. Why do I say that? The Fed prints money. The Fed prints money. Repeat after me. The Fed prints money. $27 trillion of debt. Hello? And another stimulus package, they're just going to give money away to whoever wants it. Here you go. Start your own business. Anyway, so right now, I would say this. When it comes to precious metals, if you're in them still, I would stay in them. If you're not in them, I'd wait for some kind of breakout, because it's not quite ready. It's sort of the soup needs another pinch of salt. Okay, let's move on. And this is the silver ETF. Oh, I want to puke about this one. Excuse me, please. Bah! I recommended this. Actually, let me make colors here. Oh, okay, I recommended this. This was in such a nice pattern. Oh God, still breaks my heart. I mean, it was in a perfect triangle, which is normally a continuation pattern, meaning that it tends to go with the pattern, not against the pattern. That's a reversal pattern, not a continuation pattern. Okay, so this was in a continuation pattern. I was pounding the table, recommending it, and well, let's just say I wasn't exactly right. It from here to here, that drop from about 58 to 40 happened in the blink of an eye. It looks like it's continuous because of this bar right here. See the bar right there? But it wasn't. You couldn't have sold it. I couldn't have sold it. It was just gone. So what I've done with it, it still is not in a bullish pattern yet, though it might be. We're going to show you some stuff here. I'm neutral right now. I'm going to need a little bit of evidence, but let me show you something. This thing, this pattern right here is actually, it could go both ways. This thing could be a flag pattern, which is a continuation pattern from it going down this way, right here, right down this direction. So silver's one to just sit and wait. Let it play out. That's all you can do. I'm going to show you some of the individual companies, though, and tell you that when, not if, but when silver and gold become good entry, they have good entry points at some point. These are the companies you want to keep on your watch list. One of them is Coeur d'Alene. Never talked about it before, but notice the pattern right here. Oh shoot, I drew that the wrong way. Should go green. All right. Then notice this thing. I mean, it really kind of held up pretty well. And it's already right at the top of this thing. It might make a new high pretty soon. And the stocks that exhibit relative strength, those are ones you want to keep an eye on because they are leading the market for a reason. Something good's happening. All right. And another one is Silvercorp Metals. I've held it. I've sold it. I made money, lost money. Oh God, this one has driven me completely crazy. But I like it for the very same reasons of Coeur d'Alene. It's showing very good relative strength. Look at this. Basically, look at this. It's way up here still. It really hasn't retraced its move at all, and it's had a very nice uptrend, but a short one. I mean, this thing is good for a lot of points. So this is one to keep an eye on, but not necessarily to buy today. Okay, not today. Not today. Not today. All right, so we're going to go on to the next one, and that is Wheaton. Wheaton is just a killer company. So I love this. Same reasons. I'm not going to draw on it, but for the same reasons that I mentioned Coeur d'Alene, I mentioned Wheaton. Look at that pattern. Looks like it's going to lead the charge. Maybe it will, maybe it won't. Now this one's really important. This is US dollar. This is a reason this should be kept an eye on. And the dollar is in a bullish pattern. And I hate to say that, but the charts don't lie. The charts have all the information necessary. Now look at this. This is called a rounded bottom right here that I'm drawing. And it's the opposite of a rounded top. It's a rounded bottom. Now the thing about it is that when it goes down, gold down, USD dollar up. Okay. Think of everything priced in dollars. So when the dollar goes up, the price of anything goes down. When the dollar goes down, the price of anything, including gold, goes up. Now, in this case, we have a rounded bottom. I missed that last time, but it looks to me, the last thing is going down, and that's very bullish for gold. That's another reason. Maybe maybe gold is going to become a good buy again, and precious metals again. They're not quite ready yet, but keep an eye on it. All right. All right. This is the VIX. Now, most people don't understand what the volatility of a stock market means, and it'll be explained in an upcoming video in our chart foundation series. But the VIX is a measure of volatility. Okay. Now, higher volatility occurs at market bottoms, typically, but not always. Now, notice the volatility of this thing is about to go down. It looks like it's about to go down. Hold on, and I will show you. All right, so the volatility is actually on its way down, and it's down here, and it's looking like that. And you know what? If it goes down like this, that's bad. If it goes up like this, that's bad. I mean, this is not a good pattern. This is a great time to stay in cash. It really is. So we'll get a little more confidence down the road. But right now, everything can go any which way but loose. All right, let's go on to the next. All right, I'm going to show you interest rates. This is actually one of the most interesting parts of today. All right, now this is the 3-month bill, all right, controlled by the Fed. This is the only control of interest rates that the Fed has in reality. Now, right now, they're trading at like 1 basis point, like 0.01%. Oh my God, how generous. No, it's 0.1%. God, I almost didn't give them enough credit. 0.1%. You can borrow at 0.1% from the Fed. Oh my God, how nice. Okay, so, but that's not the most important chart I have. I have much more important things to show you. Like this, 5-year. Okay, the 5-year has been stuck. Now, remember, keep in mind, these are yields, not prices. When bond prices go up, yields go down. Let me write this for you, as a matter of fact, because I think it's very important. I wrote it in my funky pen. All right, here's my funky pen. I'm going to write, oh, I want to do a different color. Okay, thank you. Oh, okay. Now, notice notice how quickly it fell. This year, the 5-year was as high as 1.75%. Okay, that was that high. Now it's at 33 basis points, and it fell all that much in just a few months. That's almost unheard of and unprecedented. What is interesting about this chart, though, is that the conventional wisdom is that interest rates are going negative, and they aren't. They really aren't. They're negative real rates, but not negative rates in absolute terms. Okay, one of the reasons that I believe that to be the case, is that I believe this is making a rounded bottom. It's a very bullish formation, and it doesn't surprise me either, because we're in a period of rising inflation. I'm sorry to tell you this, but protect yourselves from it. We will have a video on how to do that, but inflation is a problem, big one. All right. This is the 10-year. Not going to draw it again, but the 10-year tells the same thing as the 5-year, that we're in a bottoming pattern and that rates are going up. Okay, and I'm just going to remind you of one thing. Oops, I screwed up there. We're somewhere. Where are we at? Okay, let's keep moving. Sorry. Oh God, I keep doing. Okay, hold on. Okay. There we go. Now we're at the charts we need to be. All right, so this is the 30-year. Again, look at that. This is a rounded bottom. Okay, this is absolutely a rounded bottom. I mean, look at this. Well, and it's a really nice one. So it's time to lock in your mortgage and fixed rates. Okay, time to lock in your mortgage. Don't get a variable at this point. That's one of the things, one of the defenses you have against rising rates, and they're going to be rising. They have been falling for 38 years, ever since 1982. And a guy by the name of Paul Volcker was the Fed chairman. Rates at that time were close to 20%, and they kept going down and down and down and down. One of the very reasons the market is as overvalued as it is today and as high as it is today. One of the very reasons. Okay, so we're going to move on to the bank index. Okay, now I'm going to be quicker about this because they all look the same, and I don't want to keep repeating myself. I don't want to keep repeating myself. I don't want to keep repeating myself, and I don't want to keep repeating myself, and I don't want to keep repeating myself, and I don't. Sorry. Okay. You know, I drink too much coffee. That's the problem. All right. So the bank index looks kind of like every other index, so I'm not going to write on it. you know, but it doesn't look good. You know, it should be closer to making new highs, and banks and financial institutions represent a very large percentage of the averages. Okay, this doesn't look good. Hope you didn't mind that face. Okay, this one is the broker-dealer index. This is also financial institutions. This is also a terrible pattern. Look at this right here. Oh, look at this. You know, that's kind of like, yeah, you could say it's a pennant, but I don't really look like it to me. It really looks like a Head and Shoulders more than a pennant. That's just an opinion. But if you take this, and this, there's a Head and Shoulders. If it goes below 265, watch out below. That's all I got to say. All right, we're going to look at a couple. American Express, Dow Company, same pattern. Okay. Bank of America, same pattern. Bank of New York, same pattern with a little bit of a rally. Okay. Berkshire Hathaway. Oh, God. This one deserves some attention. This is probably the worst signal in the market right now. And I'll tell you why. It's in a terrible pattern. It's a bank, basically a bank holding company. It holds most of the banks that I've showed you, including Wells Fargo, which it's selling, and Geico Insurance, and a few other things. It also trades at about 2 times book value. Now, don't quote me on that, but it trades at a premium to its underlying asset value. And there's a Warren Buffett premium. Well, Warren Buffett, I think, is, you know, well, I don't want to see it happen, but he's getting up there in years. So, you know, at some point, that Warren Buffett premium is going to have to come out of this company, because there won't be any Warren Buffett to have a premium for. But I'm going to show you what I see here. And I look at this and I see this. And I go, okay, now, if you look at this right here, that is the Maginot Line. Okay, right there. So we're going to keep going on, but I wanted you to look at this because this is probably the most important chart I've shown you today. Okay, Citigroup. Looks like crap. Look at that. It's barely at a new high. Barely even bounced in last week. And it went down on really big volume right there. So I don't like it at all. I don't like it one bit. General Electric. The reason I have this in here, this company used to be the blue chip of blue chips. It was the most valuable company in the world. It had the largest market cap, and it was the most influential, and one of the Dow 30 companies that stayed in the Dow the longest. It actually was among the first of the 30. It recently, maybe 2 years ago, got kicked out for misbehaving somehow. I don't know exactly what misbehaving was all about, but I don't tend to gossip about those things, but it was apparently an affair between the chairman and his secretary. Oh, no, not really. I don't gossip about those things. Okay. General Electric is really important because of its combination of industry, makes just about everything, and its combination of finance. It leases, it's like a bank, and look at how crappy this thing looks. Oh my God. Look at that. And it barely is above its lows. You know, it's another one that's really worth looking at. Okay, let's go on to the next chart, shall we? Wells Fargo, we've already showed you that. That looks like crap. I've already said that before. Now I'm going to go on to the world markets. This is the CAC 40, the French market. And as you know, the importance of it cannot be understated, because the French are good at 3 things, very good at 3 things. 1, toast. 2, fries, and 3, surrendering. They're terrific at surrendering, and I think their market has just thrown in the white flag, and it's not looking too good. See, look, if you look at this thing, it looks like, you know, merde, as they say en français. Okay, now we let's go on to the next one. Oh, the DAX. The DAX is the German market, if you know what I mean. The reason the DAX is important is because it's a large exporter. Okay, now this one looks to me, I would say this one is a market, looks to me like a rounded top, like this. Ugh. Ugh. That just doesn't look, that is so not inspiring. Okay. So if if you're into these international funds, well, it's not a matter of what you invest in. It's a matter of things that agree with each other. You want to look for stuff that disagrees with you and consider why it might. But usually everything lines up the right direction, and then you have a low risk entry point. Like gold might be just entering that point again. So we'll keep our eye out on that, and that's something that you'll have to wait for the next show. Sorry. Same bat time, same bat channel. All right, so this one we are going to move. Okay, let's see. Yeah. Oh, okay, so got that, and we move it. All right, this is a euro index, and I really don't. To tell you the truth, I don't really like it that much, but I put it in there to show you just how far below its top is. And this is pretty much very similar to the British FTSE, which used to be the second largest exchange. But the FTSE really doesn't hold that much of a place anymore. So we're just going to keep skipping here. Hong Kong. God, I don't even want to talk about Hong Kong. The Kospi, the reason this one's important, I always put this in here. The reason this one is important is because South Korea is the largest exporter as a percentage of its GDP. And so you always want to be watching that because of, let's face it, the state we're in, as I call it, the zombie apocalypse. I am going to put green here. No, I'm going to put red here, but it could easily be green. And this one is unknown, but you got to look at it as it breaks out one way or the other. I think it's going to break lower, but I don't know. And I wouldn't bother with this anyway. So, it's not worth really investing in. It's just interesting to look at. Here's another one. Here's the Nifty 50. This one is amazing. This is India's stock market called the Nifty 50. We used to have a Nifty 50 here in the United States on the NYSE, included companies like Xerox. Who? Where? What? Where are they? Xerox. Let's see, another one, Digital Equipment. I haven't heard of it lately. Have you? No. As a matter of fact, our Nifty 50 is probably all acquired, deceased. They probably got COVID. Who knows? It's so contagious. Everybody gets it. Okay, so that's the Nifty. We're going to go on. Oh, I love this. I'm going to stay for a little bit of time on this one. See, this is the Shanghai market daily. Okay, now let's look at it from a daily perspective. Now, you would think that this is just really looking good, and it's got a nice little pattern here. Okay, that's what you'd think. Okay, wow. But let's compare it to the 20-year version and see what happens. This is it. See, what you just saw look really big? Well, that's it right here. That was oops, I forgot to freeze the screen. There we go. That was this right here. You just saw that. Okay. What you didn't see was that or that. You just saw that. Basically, and this happened in 2008. So China, well, let's just say they're not the threat economically that they would like us to believe they are. They're thieves. Yeah, they do steal intellectual property, but their GDP is completely fabricated. GDP, which is the size of the economy, is basically a function of two things only. It's the number of labor hours worked times productivity, which is typically 1% a year, 1.5% in the United States or so. Now, China, they began a one-child policy. They've had no growth in their population. And I don't know about you, but I don't see the productivity gains in having most of them picking rice in rice fields. So that really, that kind of slays me. Don't be afraid of China unless someone's throwing a piece of China at you. Anyway, I've had a great time with you guys today. And next time we are going to talk about some, not only update you on this, but maybe give you some ideas on what to buy to take advantage of this. All right. I've had a great time today. Talk to you soon.